Stocks and commodities climbing today as ADP said that U.S. companies cut the fewest jobs in 2 years, and Greece announced its plans to rein in debt. So what sectors are looking the best today, and what about the rest of 2010? Joining us now is Craig Peckham. He's an equity trading strategist with Jefferies Co. Craig, thanks for spending some time with us today. Let me ask you, does it make sense to you to go bullish today? Do you get enough good news out of Greece, out of labor, out of the ISM to go out there and put risk back on?
Yeah, I think that this is a good time on this pullback in equities to be scaling back into risk here. I don't think that we're completely out of the woods with respect to the economic data stream in the short term. Let's talk specifically about this ADP number. The number came basically in line with consensus expectations. I think the marketplace has been bracing for a negative surprise on this number as a look through to Friday's report. There's an important distinction that's been pointed out by our economists, which is the sampling methodology in ADP's data versus the BLS data that comes out on Friday. The net of all that is that there is still some risk that we could get a downside surprise relative to consensus expectations because of weather effects in the month of February. That leaves some room for some volatility on Friday. Big picture, though, I think easing of the concerns coming out of the sovereigns in Europe helps the picture. I think it gets people more refocused here on the industrial recovery story globally. Hence, strength in energy, strength in materials, strength in the industrial sector. Three themes that we think would make a lot of sense over the balance of the year.
So what about the risks that are still out there? I mean, this Greece situation is definitely not over, for example, Craig.
No question about it. And I think this global issue of stressed sovereign balance sheets is going to persist for a while, hence the need to undertake a lot of very hard decisions about deficit reduction and budget balancing. All that being said, I do think one of the upshots of that dynamic is you're seeing the problem being acknowledged. You're seeing it being dealt with in a very formulaic approach. And one of the elements of the materials trade that we do like is that to the extent that we have a persistent risk of currency debasement that's a byproduct of this sort of deficit threat that's out there, brings us back to hard asset plays. One of the reasons why we continue to think the portfolios need to have some energy exposure and some materials exposure gives participation in an industrial recovery as well as some protection from some of the currency threats we've been talking about.
And what about the jobs picture? I know you say that there is encouraging jobs data relative to diminished expectations, but we're still going to see or expected to see a big drop on Friday with the all-important non-farms payrolls number, and we're going to see a tick up, consensus says, in the unemployment rate.
Yeah, this is a really tricky call, Matt. If you look at the setup for Friday, it seems that we've had a lot of important figureheads conditioning the marketplace for a potentially disappointing number on the back of weather. The question is going to be how much the market's willing to look through that February number, given the weather anomalies, which are very real and happen to coincide with the sample week for the BLS data, and willing to look ahead to March, where the trend line seems to be a continued slowing pace of job reduction. We're not ready to say we're on track for a consistent pace of job creation here, but it does seem as though directionally here things have firmed or moving in the right direction.
All right.
Craig, thanks so much for joining us. Craig Peckham there from Jefferies and Company.